The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And we're here to talk about money. It is Saturday. And you know, this past week, the Consumer Price Index number came in, the Producer Price Index came in. Both were up for a second month in a row. We've been alerting people that there could be a change of inflation. Is this the beginning? I mean, 1 point doesn't make a trend. 2 points make a line, but they don't make a trend. But we think that there may be something going on. There's been a lot of talk about six rate drops, 6 times to drop the interest rate.
Yeah, Kathy Wood was the one who mentioned that. I don't know who else came up there, but I saw her.
A few others. CNBC had it going for a long time. Mm-hmm. Now a few people are saying 3 instead.
I heard two. I think it's down to 2.
I've heard 2?
Yeah.
Do I hear 1? Do I hear 0? It's very possible 0 or 1 or 2 this year.
Inflation's funny, Mike. It's like that, it's like weight loss, right? You get the first big move, and then to stomp out that last few percent is really, really difficult.
But it's also a difference in what we've been seeing as demand pull.
Yeah.
And that's where you have too many dollars chasing too few product. Mm-hmm. You have people with stimulus checks, with those checks and no place to spend it because they were sheltering in. And then you have a shortage of supply. You had a shortage of cars being made because of chips. You had a shortage of refrigerator motors, so refrigerators weren't in supply. You had a lot of supply that had to be geared back up. The plants had been shut down, but people had a lot of money to spend, and they were spending it. And so you had a demand pull. Remember, car prices shot through the roof.
Used car prices were just as expensive, so people just said, I'll just buy brand new. There's no point in buying a used car.
I know. I had a friend who had a Mercedes, and he said the Mercedes, he leases the car. And the Mercedes people called him up. This is a year, 18 months ago, maybe 2 years ago. Mm-hmm. I don't remember. But the Mercedes people called him up and said, your lease is going to be up in 6 months. If you bring the car in, we'll give you a $5 bonus to lease a new car.
Yeah. Same thing happened with a buddy of mine with the BMW. They said, bring it back in. We'll just give you a brand new one.
Yeah. So that was demand pull. But what cost push is when you have wages increasing or materials.
But we've seen materials come down, right? Materials haven't. So it's wages. We've talked about this before, that how can you stomp out inflation or we talked about it first in the context of the recession. How can you have a recession with such a tight labor market where people can go and then get a new job and make more money?
Yeah.
And how can you on the reverse, how can you stomp out inflation when you still have a really tight labor market?
You have 4 million more jobs than you have workers to fill those jobs.
Yeah.
And what we're seeing is more strikes. Last year, 17 million man days lost, or person days, I guess, to be politically correct. But 17 million days lost due to strike.
Yeah.
That's more than the previous 10 years combined. Mm-hmm. We're seeing wages increase at 4.5% and productivity at only 1.2%.
Mm-hmm. I was speaking of weight loss drugs. I read an article about the GLP-1 drug, and they think they're going to have an impact on the economy by increasing productivity and getting more people back to the labor.
There'll be a loss involved of pounds.
Yeah. Yeah, but they think that it could increase productivity because more people will come back to the labor force. What does that do to inflation over the next few years if that's the case?
It would be positive, but you still need to bring in 3 or 4 million more people.
Yeah, they say there's a lot of people on the sidelines that stepped away and they're unproductive because of the obesity epidemic. And they said because you can lose up to I believe a third of your body weight drug. It's significant. It's not just trivial amount of weight that people are losing.
Yeah. No, it's very positive for the drugs. But in the meantime, until we see the impact, and that's going to be a lagging thing, mm-hmm. We're seeing labor rates increase, no sign of slowing down, and that's pushing up inflation because the companies can see that their costs are rising. And so when costs rise, what do? Increase your prices.
Or what other thing that's going on, Mike, is shrinkflation.
Yeah.
your bag of potato chips. Wait a second, the chips are a little bit smaller and the bag's a little bit lighter.
Seattle Times have been doing that for decades.
The paper's smaller and smaller and smaller.
Yeah.
More ads and less content.
Actually, not as many ads because they're losing revenue. They lost the classifieds.
Oh, the classifieds are gone. I'm just talking the ones that the insert ads that go in.
Yeah. So anyway, we're going to come back and talk about this. I mean, I'm not sure how many people really understand the difference between demand pull and cost push. I've talked about it before, being at the luncheon with First Trust, and they're pretty sharp guys. And when I asked the question about demand pull or cost push inflation, the response was, inflation's inflation.
Yeah.
I mean,
Plus, what's going on in the Red Sea, you had a little bit of bottleneck inflation too, which, not necessarily as bad as it was a few years ago. I'm not saying it's maybe not statistically significant. Maybe it is, maybe it isn't. But it has been causing some disruption in the supply chain.
It has. All that. We're going to come back to that and talk about that. We have a guest today who's here. He was on the program in 2015. He's got a new company. We're going to be talking about that. So you want to hear what he has to say. And we maybe get to talking about some of the ways in which we manage money. But first, let's talk about what's gone on. Because in 2011, I began talking about a super cycle, a period of time in which the GDP of the world grew at a faster rate than average. The first cycle was from 1870 to 1913, 43 years, driven by the industrialization of the U.S. The second cycle was from 1970 to 1945, driven by the rebuilding of Europe and the decolonization of Africa and Asia. Third cycle started in 2009 and is expected to last until 2030. A lot of people talked about the super cycle up until COVID hit. And since COVID, nobody's really talked about the super cycle, or people are saying, what super cycle?
Yeah, but I think COVID enhanced the super cycle. I mean, you talked about that maybe a couple of years ago, right after COVID, because of the changes in the way they're processing, how slow the FDA was, right, when they instituted how to get that drug to the goal line as fast as they could. And they did an amazing job doing that those changes could actually enhance the super cycle for development for not just drugs, but a lot of other things getting through pipelines for products and things, especially with the advent of artificial intelligence.
And the world is really flat. I mean, there was a time at which a lot of information existed in the United States at the universities, but because of the internet, that information is available everywhere. I did some work in the country of Georgia and in the Ukraine at one time, and they had access to everything we do on the internet. They just open up their computer, log in, they can Google, they have Gmail accounts, they can see what we see.
But the advent of the mRNA vaccines was a game changer, and getting it through in 9 months was a massive accomplishment.
Yeah.
So things like that, things are moving faster and faster with the advent of AI. We've seen that just take off, and we're in the infancy stages of it.
It's very reminiscent of the dot-coms.
It is, but yeah, it is.
In the early day, I used to say for the internet, if you looked at Microsoft, what was happening is that computer memories were doubling every 18 months. And that allowed Microsoft and Oracle and the software companies to continue to increase the amount of script that they were writing. At one time, back at the end of the 80s or early 90s, I looked at the number of lines of script in Word was 10 times what it was for the space shuttle to go to the moon. I mean, but because computer memories were doubling every 18 months, it allowed computer companies and software companies to write a lot more script. That was 18 months for computer memories to double. The internet was doubling every 6 months. And I said, the real question is how to monetize it. AI, it's going to be the same thing. How do you monetize? How do you get paid for it? How do you use it? How do companies use it? There are going to be some of those companies that really understand how to use it, and others that come along and maybe write a business plan or may have a thing that says we know how to use AI, that truly are just blowing up a storm without anything real.
I think you're also AI accelerating businesses. So you're going to create a greater divide between have and not. The access understanding of it, build a business successful or scale that those that are access be further behind and slower to.
Yeah, I think that was true of the internet.
Oh yeah.
The companies that were able to figure out how to do a web page, how to do that information, were much further ahead. I can remember going to a seminar at one time where people talked about the number of people that were checking web pages to verify the credibility of a company, it was like 90%. Anyway, we'll come back to that and finish this right after this commercial break. Don't go away. We'll be right back.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I want to finish a thought I started and I only got partway through. I said that I went to a conference early in the days of the internet, and over 90% of people were checking the validity of companies, but fewer than 50% of the companies at that time had internet or had a website, is what I to say. Fewer than 50% had a website. And so those companies that didn't have a website were being considered not viable, and that cost them business. And your comment, Kevin, that the people that understand AI are going to be the ones that are ahead, and those that don't understand and don't participate and don't understand and they're going to be left behind. It happened with the internet. Take it way, way back. It happened with electricitors. It happened with lighting in factories and electricity.
Well, I think it goes way back. I think it was marked by stock and American telephone. Oh, those are stupid. Nobody's ever going to want to use one of those.
That's true.
That's a true story.
And no, it worked out. Who has a landline anymore?
Yeah, exactly.
Anyway, coming back to this, during the last great inflationary period of time, one of the best hedges was commodities. Oil soared from less than $10 a barrel to over 60, a six-fold increase in just a period of 18 months, 10 to 60. Platinum soared tenfold. Think today if oil surged from its current price to over $400 a barrel. Think of what you'd pay for gasoline. All of that. But as inflation hit, stocks did not do well. Bonds did terribly because as interest rates went up, bond prices went down. But even as stocks hit 1,000 in 1966, then they sold off 20%, and then they rose back to 1,000, and then they sold off to 30%. They rose back to 1,000, and then they sold off 40%, back to 1,000, and then sold off 20%. And finally, in August of 82, 16 years later, the Dow finally passed the 1,000 mark and then went on to 11,000 in 2000. But in those days, you could invest in oil companies early on. They would also suffer later in the time. But commodities were a place to be. The question is, will commodities be a place now?
No, they haven't proven they've done terrible. Most commodities are down, I think, 29% from their high.
And is it a temporary situation, or do you think we're going to see commodity prices rise?
It depends on which commodity you're talking about. Oil, we talk about all the time, peak oil. We keep coming back to peak oil. I think oil is going to continue to rise. I don't think production is going to continue. I know you say that the peak gasoline is different than peak oil was 2018 at peak because we don't refine any. But I still think that the countries that are industrial will pick up the slack. The commodities, wheat and these other commodities, we've seen lithium and those commodities that were really high in 2021, lithium and cobalt and nickel, which make electric batteries. We've seen those drop precipitously. Nickel's down 50% and lithium's down almost.
But how much of the increase was due to speculation?
I think
a lot.
I think a lot of speculation in lithium, and especially in the nickel industry, which is tightly controlled by I think a few. What was that company that guy was trying to corner the nickel? Archegos?
I don't remember.
You remember in 2021 there was a guy in Britain, he was trying to corner the nickel market. He got pinched.
Yeah.
And his whole hedge fund went belly up as he bet the wrong way. The thing went sideways. He was trying to corner the whole market.
Sounds like the Hunt brothers and silver. Way back when.
Yeah. But so I don't know if we'll see commodity.
One of the problems is commodities are something that you have to mine, and governments are becoming more and more taking more and more regulation and slowing down the process of, you can't just go buy a bulldozer and start shovel or whatever.
But here's the thing, like gold prices are been rising fast too.
Gold prices. And
I don't think, like you said, mining it's labor intensive, extremely expensive, and it's not environmentally. That's not like it's a zero. It's not like going to EVs is a zero sum solution because you got to mine all the material.
Yep. And countries are beginning to realize if you can control the commodities coming out of the ground, you can force companies to come to your country and build plants to use it. Indonesia is a great example.
Well, China with the lithium, they have the largest lithium. Tesla, okay, come here. Yeah, we'll give you the lithium, but come here and build a factory.
Yep.
But now they're developing these sodium-ion batteries that they don't use lithium or cobalt, and they say they're just as good.
Well, yeah, assuming that the technology works.
Yeah.
Assuming that the silicon replaces graphite, you can get a battery 3,000 miles a car build batteries to get 3,000 instead of 300.
Yeah, and the fuel cells, if they built the hydrogen if charging, they charge in 3 minutes, and they get 930 miles. That's pretty good.
It is, but the fuel cells are for some use.
I don't know why we didn't go that route. Hydrogen charge 3 minutes.
It's expensive.
Oh, I know it is.
I think there was all that ran out.
Yeah, but
battery.
I was listening to a guy yesterday on the the Inflation Reduction Act and the subsidies and the government credits. You can pile with that. You can pile tax credits on top of tax credits for like indefinite.
Yeah,
that is a government giveaway. That whole program. He's talking about how many you can pile the environmental tax credits on top of the employee tax credits on top of DEI tax credits. They said it's just on top of for extended periods.
Yeah, and that's gonna until the government takes away the tax credit. It becomes a really good deal for people that are involved with that.
Yeah, we talked about carbon recapture. It's extremely expensive. It's double the cost. If I want to build a plant to mine for natural gas, double the cost to do the carbon recapture. But the government subsidies make it about the same price.
As long as the government subsidies remain.
Exactly.
As soon as they go away.
2033, they go away, according to the carbon recapture.
But commodities themselves, I mean, we're in a world that's very, very different in 7. And, the capacity for drillers, the capacity for miners has to be increased significantly for commodities or the price has to rise. And the assumption is that with inflation, maybe you get price increases, but it's not a sure thing. It's not like the 1970s where you could invest in Apache oil and see your stock price increase, even though the stock market was going. To me, it doesn't make a lot of sense to think about commodity investment at a time when commodities are controlled in a lot of places outside the U.S. Mm-hmm. Nickel in Indonesia, lithium in China, molybdenum is it Ghana?
And cobalt's all in Africa.
In Africa. And so you're at the mercy of those countries to furnish those products. And what will they charge for them?
Who knows?
And if they can't get enough, will they cut the price dramatically? And are you willing to take the risk of a foreign stock?
The guy for Barron's, Jack Ho, he's kind of a funny, and he did this article a few weeks ago about investments. We maybe talk about it later on, but he said all you really need is investments in the S&P 500 stocks, S&P 500 to do well. He said you don't need commodities, you don't need structured notes or anything like that, or foreign all these complicated investments, because just as you said, you're stuck at the whims of these government. He said, and all the companies in the S&P 500s we talked about have 30-40% of their revenues are from overseas. So you're getting exposure. And if you want oil exposure, instead of buying commodities, buy Exxon, buy Mobil, whatever, buy one of those companies. If you want commodity companies, if you want wheat, buy Archer Daniels Midland. They do soybeans and control that stuff. You're getting exposure there. You don't need to go to these extraneous solutions to diversify your portfolio. What did Peter Lynch call it? Diversification?
Yep. On the other hand, when you think about the 1970s, that strategy did not work because there were so many companies that were going down when other companies were going up that it dragged the whole thing down. 1966, the Dow peaked at 1,000 and dropped 2%. 1968, the Dow was at 1,000 again, it dropped 30%. 1972, Dow was at 1,000, it dropped 40%. So just being in the S&P 500 is probably a losing strategy. What we've seen with the inverted yield curve is that we know that recessions always have an inverted yield curve. Mm-hmm. But inverted yield curves don't always mean a recession.
Yeah, and in the S&P 500, I can't remember since 2000, the last 5 years, been up 11.3%. And this the index, the Cape Shiller index is they measured this. They said there was up about 38 before the .com crash. It's up about 33 right now. Measures the ratios of PEs to the stocks, the whole S&P 500. And so the prediction is that after because we've been up 11.3% over the next 10 years, the S&P 500 probably not going to do that well.
Don't go away. We'll be right back after this commercial break.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So, talking about the inverted yield curve as a side tangent reminds me of Paul Samuelson's economics textbook. Back in the 50s and 60s and 70s, everybody read Paul Samuelson's textbook. It was the most popular, probably 90% of economics students used that. One of my professors at Carnegie was George Leland Bach, who wrote the second most popular textbook that had about 5% of it. But Samuelson opened one chapter by saying the stock market has correctly predicted 5 of the last 9 recessions. No, I got it reversed. correctly predicted 9 of the last 5 recessions. So depending upon the inverted yield curve to predict a recession has it in reverse. Recessions always have an inverted yield curve, but yield curves don't always have to be followed by a recession. I think looking at and thinking about this concept that you can diversify into the Standard & Poor's 500 and think that you're going to get through a period of time of great inflation is something that we saw in the 1960s and 70s did not work. And I believe there's a reason it did. And I believe the probability is it won't work when we come to the next period of time inflation. One of the things that grew out of the last inflation period of time was the inflation bonds. The Treasury inflated I-bond. The idea is the coupon rate adjusts with the consumer price index. So if the consumer price index goes up, the coupon, you get paid more. You get paid in relation to inflation. Seems like a brilliant concept, right? Did it work?
No. Inflation bond, $100 inflation when it's 5.
Yep.
They work well, but as long as the Fed isn't raising interest, when they start raising interest, bond goes.
So you have 2 things with the bond. You have the interest rate they pay and the price. The interest rate goes up, but the price goes down. And the price goes down a lot more than the increase in the coupon interest.
And so last year, Mike, $17 billion.
Yeah. So for it's one of those popular Wall Street things where they come up, you have brilliant Wall Street guys come up with these brilliant ideas. Have a bond where the coupon increases with the rate of inflation and you'll stay up with the rate of inflation.
Or you'll slightly.
Yeah.
Depending on the interest rate.
Yeah. Sadly, you may have a good interest rate, but you lose your principal. Anyway, inflation, it's coming. In all probability, we're going to see inflation tick back up rather than slide back down. Will we get to 2%? Probably not. Will we get much higher than 10%? There's a possibility. Anyway, that's down the road. We'll see it. We'll keep you informed as we go along and stay on top of it. By the way, we do have an approach that we're using for our client, which we think will work through the inflationary of time. But that wraps that up. We want to turn. Kevin Maude was on our program in 2015, just 8 years ago. 9 years ago?
Yeah.
9 years ago. Anyway, at that time, he was the owner and CEO of a company called B47.
Yeah, B47 Studios.
B47 Studio. Today you have launched a new venture.
Yeah, we launched a new venture last summer called Apex B47 Studios, more about strategy of utilizing video, how to connect audience.
Before we get to that, let's start with your background. Tell us about your background.
Yeah, so I went to school for film and video production. And during that time, graphical internet's developed, and I got really... as I moved to Seattle, I started to explore, how can you connect audience and connect meaningfully through the internet, and I really got into that and being able to, you talked about earlier, flatten out those connections to the world, be able to talk to somebody in Africa or be able to engage and get new points of. So I explored a lot of that through Avenue. I launched B40 Studios through that and learned a lot from it. I've launched, but most of them have been geared towards some sort of visual.
Go ahead.
Tell us about.
Yeah, so our business right now, we're really what we do is we like to identify what your goals are, what you're trying to accomplish, and design a strategy that utilizes video content. So we know that video really resonates well with prospective clients, partners, or even current partners, because it builds an emotional connection that is light. And once you have that emotional connection, you're able to build an audience that knows, likes, and trusts you. And once you have that, they'll start to buy from you when they're ready. Because today, many people believe that, I got to go target these people right now, right at this very moment, but they might not be ready. The stat is only 3% of buyers are ready to buy it. But if you can nurture the 7% when they're ready.
So when you talk about nurturing, how do you do that?
So it's really about bringing value to them and giving them knowledge, understand what they're trying to. So case Mike, the radio show, great example of be able to bring them value, bring them insights, and help them be educated in the market about, investing.
So talk about a typical type of client that you would have.
Yeah, most of our clients are geared we're working with a lot of entrepreneurs in subjects. A lot of might have businesses in a stagnant place, have been doing old form marketing, business development, and are looking to grow, utilize LinkedIn quite a bit but also utilize content and build strategy and learning the viewers. So it's really about We work a lot with entrepreneurs, subject, and then those that have addressed. So some clients that are trying and find the right audience, because often business owners believe they understand who they want to be talking. Their messaging might resonate with completely different, unknown, to be able to speak to them a lot better and see a lot more, your investment going a lot further. Yeah, it really depends on kind of the life cycle of your business. So, somebody that might have a small audience now, you might see some progress in a couple months. Some of the affinity group work that we're doing, that does take a little bit longer because we have to get a lot of eyeballs there to go against. So that can take up 6 months to really start. It could be as short as 3 months. But, those that have an audience, you might see it quickly. Those that we're having to really develop the audience, understand who that audience, it could take, a couple months to start to see that as a magic bullet anywhere that's going to get you right away.
But yeah, so it's all about getting that content out there, hit them, develop it. Content is the real rub. Rubber hits the road, I guess, right? Is content that is pertinent to the people you want to target, and that's going to give them something, giving it away a little to kind of draw them in.
Yeah, so showing that you're an expert, showing that you can give them value just by giving them, simple insights, or giving them, this is how I got started in doing this, or this is something to think about as you're considering a move in your business. Kind of guiding them along those ways and getting them to understand your belief, but also being unique in that position, so that you.
So give us an example of a potential client.
So a potential client for Apex?
Yeah.
So a business owner that's probably been in their business generating $1 million in revenue, but has been stagnant, and is really looking at how they or wanting to grow their business, but have been struggling to find the audience to grow it and bring in.
And so the process that you would go through with that business?
Yeah, so our process, right now, we actually have designed a new process for our thought leadership. We have a no-cost Kickstarter program that basically goes in, helps you to identify your brand, and by identifying your brand, it creates an emotion, understand the emotional connection, create with the audience. Then we go in and create a video, brand video, and then from there we create a content, and that's all at a no-cost program. And then from there it goes into a subscription model where we're creating pieces or video content with you on a monthly, then to resonate.
That's pretty awesome.
Yeah, we think it's a fairly good offer, and a lot of people be interested in it. It's finding the time to do it.
We'll be right back after this commercial, and we'll let you know how you can reach Kevin, and that will be coming right up. Don't go away. Stay with us.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So we're here with Kevin Mudd. Kevin, tell us quickly what your business does, and then tell the listener how they can reach you.
Yeah, so Apex Studios, we build strategies for business growth with video by engaging audiences and help them to grow your business. To reach me, my company is Apex Studios, and it's apexstudios.io. And my email is kevin@apexstudios.io, and I can also be found on LinkedIn. Profile is.
So say it all again.
That's.
You threw him off, Mike.
Yeah.
He said it once really good. Come on.
Had it all down pat. Yeah, no, we build strategies through video content, or we build strategies to grow business video that help you. And you can find me at APIO is website. Email address is Kevin. Find me on LinkedIn.
Perfect. Thanks for being on the program.
Kevin.
Yeah, thanks for having me.
Yeah, great talking.
So John Train wrote a book called The Money Masters. And he talked about some of the very few, actually, money masters who truly were able to outperform the market, deliver superior results. And I take a quote from that because John Train wrote, "There's no luck to professional portfolio investing. It's a craft involving thousands of decisions a year. You can no more pile up a superlative record by luck or accident than you can win a chess tournament by luck or by accident." That's how John Train described it. And at Adams Financial Concepts, that's been our focus. We have a passion for creating wealth for our clients. Clients who don't accept average or mediocre, clients who don't want to reduce their tax liability, clients that want to leave something for their heirs, clients that don't want to reduce their quality of life, even in periods of inflation, and clients who want to win. Is that how you would describe it?
Yeah, I'm just laughing at the client who just left us. Should we talk about that?
Sure.
So we just lost it. It took me a year to bring this account. He brought over a nice chunk of change. He was in convoluted, structured, and we're never going to put expensive. And he just moved the account on a whim. The account was up 21.25%. He moved the.
And before that, he was getting 3%.
Yeah, he was lucky to get 3% because he was paying about 3.5%. So if he got 3%, he was still losing a half. And he moved, and I said, "Why did you move it?" His brother told him. "What does your brother do?" Experience? Well, his brother, a professor of finance. No, he's a professor of Middle East study. Like, oh, that has a good, maybe he's got an inroad with the Shah. I don't know, some new oil. I was flabbergasted. No plan. I'm moving it here.
And
okay.
He's retired.
Yeah. No, he's still working.
Still working, okay.
Yeah. But I'm just flabbergasted. I could see if he was down 21%, I could understand. But who moves an account?
Sometimes in my career, and I've been in this business now for 30 years, sometimes people move their accounts. You wonder really why. I had one client that moved their account because they were making too much money and paying too much in tax. I said, I can cure that if you want me to. We'll just lose money for a while. I said, the option is not to make as much money or to lose money. I mean, if your account goes from $1 million to $1.5 million and you have to pay taxes on $500,000, isn't that better than paying 20% capital gain, so paying $100,000 in taxes? Isn't that better than seeing your account go from $1 million to $1,100,000, paying $20,000 in taxes? Wouldn't you rather pay $200,000 and have your account at 1.5 rather than pay $20,000 in taxes and go to 1.1?
It's hard to figure out some people's rationale. Like I had a guy do that last year, Mike. He complained about, he was comparing me against while I was down a little. His account was 1.2 over like 2 months. Not really a good comparison. Then our account started to do well. We're up like 30%. He moves the account. I said, "You're up 30? Well, you don't like making money, I guess." Okay.
So it's a funny... People move for funny reasons.
Yeah.
Way back when, back in the 80s, when bond prices were falling off. Interest rates were coming down. Volcker had raised rates and the economy was coming back into line. You could buy bonds at 40 and 50 cents on the dollar. Bonds like Seattle City Light, Tacoma City Light. I remember those bonds. They were a 4% coupon selling for 40 or 50 cents on the dollar. And you could buy those bonds at that price. And those bonds had been defeased. So the money to pay those bonds off had been invested in treasuries. So the value of those bonds were backed by the full faith and credit of the U.S. government. Could not get anything safer. The prices were 40 to 50 cents on the dollar. And there was some rookie broker from Kidder that talked to one of my clients that said, "You're getting junk bond. That's why you're paying such a low price."
I don't think he knew what a junk bond was.
I lost the account because that Kidder broker talked that client into thinking that those were junk bonds.
All you got to do is look at the rating. You can tell what a junk. It's so easy to tell what a junk is.
Yeah. So in those days,
What's that, Kevin?
Oh, I was going to say, and that's where you producing some content to educate your market.
Yeah, no, you are correct, Kevin. Yeah. You are correct. What's the difference between a junk bond and a treasury bond and a what do they call it? Municipal bond, right? I mean,
yeah, that could be the month of April for you.
Yeah, there you go.
Municipal bonds. I mean, there have been some really strange people. I had one woman who we bought some stocks, and the account was down after 2 months. It was down about 10%, and she moved the account. Okay, I understand. So a couple years later, I was at Payne Weber when I opened that account. I had then moved on to Dane Bosworth, and a couple years later, she realized this account would have been up 40% instead of being down. So she called Payne Weber and said, "Where's Mike Adams?" Well, he moved to a different firm. He's not with us anymore. "I need to know where Mike Adams is." "Well, we can't tell you that." "I need to know where Mike Adams is." She raised holy whatever to find out where I was and called me up and said, "I need to open an account." And I said, as I talked through it, I said, "You can't live with something that's down 10%. You can't sleep." I said, "You're better off forgetting about 40%, better off just putting the money into CDs and leaving it." Never went back. But I mean, that was inappropriate. She wanted to make money, but she wanted risk. If you want to make money, there is a risk. There's going to be ups and downs.
Peter Lynch said, go look at Warren Buffett's 58-year track record. He had time, but he missed the market. But he's overall 58-year track. He best the S&P 500 10%. But he had times where they called for his head in 2001, 2002, and 3. He said his wave investing's over when the A shares of Berkshire Hathaway were at 42,000. Now I believe they're over 600,000.
Yeah, I remember that time.
Yeah, I remember.
He's lost his touch.
Yep.
I'm sure some people say that about me at times.
I say that about but it has nothing to do with investing.
Anyway, that wraps us up for today. Investing is a tough game. It's not an easy game. And that's why we focus on what we do good at. Anyway, that wraps us up for today. We'll be back next Saturday to talk about money. Have a good week and a good week.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.